An introduction to ratio calculation and analysis. Watch the following video to learn about ratio calculation and analysis. Ratio analysis. Introduction. Defining ratio analysis. Ratio analysis consists of calculating financial performance using 5 basic types of ratios: profitability, liquidity, activity, debt, and market. Key points. Ratio analysis consists of the calculation of ratios from financial statements and is a foundation of financial analysis. A financial ratio or accounting ratio shows the relative magnitude of selected numerical values taken from those financial statements. The numbers contained in financial statements need to be put into context so that investors can better understand different aspects of the company's operations. Ratio analysis is one method an investor can use to gain that understanding. Key terms. Liquidity. Availability of cash over short term. Ability to service short-term debt. Ratio. A number representing a comparison between two things. Ratio analysis. The use of quantitative techniques on values taken from an enterprise's financial statements. Shareholder. One who owns shares of stock. Classification. Financial statements are generally insufficient to provide information to investors on their own. The numbers contained in those documents need to be put into context so that investors can better understand different aspects of the company's operations. Ratio analysis is one of 3 methods an investor can use to gain that understanding. Financial statement analysis is the process of understanding the risk and profitability of a firm through analysis of reported financial information. Ratio analysis is a foundation for evaluating and pricing credit risk and for doing fundamental company valuation. A financial ratio or accounting ratio is derived from a company's financial statements and is a calculation showing the relative magnitude of selected numerical values taken from those financial statements. There are various types of financial ratios grouped by their relevance to different aspects of a company's business as well as to their interest to different audiences. Financial ratios may be used internally by managers within a firm, by current and potential shareholders and creditors of a firm, and other audiences interested in understanding the strengths and weaknesses of a company, especially compared to the company over time or compared to other companies. Type of ratios. Most analysts think of financial ratios as consisting of 5 basic types. Profitability ratios measure the firm's use of its assets and control of its expenses to generate an acceptable rate of return. Liquidity ratios measure the availability of cash to pay debt. Activity ratios, also called efficiency ratios, measure the effectiveness of a firm's use of resources or assets. Debt or leverage ratios measure the firm's ability to repay long-term debt. Market ratios are concerned with shareholder audiences. They measure the cost of issuing stock and the relationship between return and the value of an investment in company shares. Defining financial ratio. With a few exceptions, the majority of the data used in ratio analysis comes from evaluation of the financial statements. Key points. Ratio analysis is a tool for evaluating financial statements, but also relies on the numbers in the reported financial statements being put into order to be used for comparison. With a few exceptions, the majority of the data used in ratio analysis comes from the financial statements. Prior to the calculation of financial ratios, reported financial statements are often reformulated and adjusted by analysts to make the financial ratios more meaningful as comparisons across time or across companies. In terms of reformulation, earnings might be separated into recurring and non-recurring items. In terms of adjustment of financial statements, analysts may adjust earnings numbers up or down when they suspect the reported data is inaccurate due to issues like earnings management. Key terms. Earnings management. A euphemism, such as creative accounting, to refer to fraudulent accounting practices that manipulate reporting of income, assets, or liabilities with the intent to influence interpretations of the income statements. Valuation. The process of estimating the market value of a financial asset or liability. Ratio analysis. Ratio analysis is a tool for evaluating financial statements, but also relies on the numbers in the reported financial statements being put into order to be used as ratios for comparison over time or across companies. Financial statements are used as a way to discover the financial position and financial results of a business. With a few exceptions, such as ratios involving stock price, the majority of the data used in ratio analysis comes from the financial statements. Ratios put this financial statement information in context. Prior to the calculation of financial ratios, reported financial statements are often reformulated and adjusted by analysts to make the financial ratios more meaningful as comparisons across time or across companies. In terms of reformulation, one common reformulation is to divide reported items into recurring or normal items and non-recurring or special items. In this way, earnings could be separated into normal or core earnings and transitory earnings, with the idea that normal earnings are more permanent and hence more relevant for prediction and valuation. In terms of adjustment of financial statements, analysts may adjust earnings numbers up or down when they suspect the reported data is inaccurate due to issues like earnings management. The evaluation of a company's financial statement analysis is a form of fundamental analysis that is bottom-up. While analysis of a company's prospects can include a number of factors, including understanding the economic situation or the industry or sentiment about the company or its products, ratio analysis of a company relies on the specific company financials. Defining industry comparisons. While ratio analysis can be quite helpful in comparing companies within an industry, cross-industry comparisons should be done with caution. Key points. One of the advantages of ratio analysis is that it allows comparison across companies. However, while ratios can be quite helpful in comparing companies within an industry and even across some similar industries, cross-industry comparisons may not be helpful and should be done with caution. An industry represents a classification of companies by economic activity, but industry can be too broad or too narrow a definition for ratio analysis comparison. When comparing ratios, companies should be comparable in terms of having similar characteristics in the statistics being analyzed. Valuation using multiples only reveals patterns in relative values. For multiples to be useful, the statistic involved must bear a logical, meaningful relationship to the market value observed, which is something that can vary across industries. Key terms. Metric. A measure for something. A means of deriving a quantitative measurement or approximation for otherwise qualitative phenomena. Valuation. The process of estimating the market value of a financial asset or liability. Industry comparison. One of the advantages of ratio analysis is that it allows comparison across companies, an activity which is often called benchmarking. However, while ratios can be quite helpful in comparing companies within an industry and even across some similar industries, comparing ratios of companies across different industries may not be helpful and should be done with caution. An industry represents a classification of companies by economic activity. At a very broad level, industry is sometimes classified into three sectors: primary or extractive, secondary or manufacturing, and tertiary or services. At a very detailed level are classification systems like the ISIC, International Standard Industrial Classification. However, in terms of ratio analysis and comparing companies, it is most helpful to consider whether the companies being compared are comparable in the financial metrics being evaluated in the ratios. Different businesses will have different ratios for different reasons. A peer group is a set of companies or assets which are selected as being sufficiently comparable to the company or assets being valued, usually by virtue of being in the same industry or by having similar characteristics in terms of earnings growth and return on investment. From the investor perspective, peers can include companies that are not only direct product competitors, but are subject to similar cycles, suppliers, and other external factors. Valuation using multiples involves estimating the value of an asset by comparing it to the values assessed by the market for similar or comparable assets in the peer group. A valuation multiple is simply an expression of market value of an asset relative to a key statistic that is assumed to relate to that value. To be useful, that statistic, whether earnings, cash flow, or some other measure, must bear a logical relationship to the market value observed, to be seen, in fact, as the driver of that market value. The price-to-earnings ratio, for example, is a common multiple but can differ across companies that have different capital structures. This could make it difficult to compare this particular ratio across industries. Additionally, there could be problems with the valuation of an entire industry, making ratio analysis of a company relative to an industry less useful. The use of multiples only reveals patterns in relative values, not absolute values such as those obtained from discounted cash flow valuations. If the peer group as a whole is incorrectly valued, which can happen during a stock market bubble, then the resulting multiples will also be incorrectly valued. Defining benchmarking, comparing the financial ratios of a company to those of the top performer in its class, is a type of benchmarking. Key points: financial ratios allow for comparisons and are therefore intertwined with the process of benchmarking. This involves comparing one's business to that of relevant others or of the same company at a different point in time processes using a specific indicator or series of indicators. Benchmarking can be done in many ways, and ratio analysis is only one of these. One benefit of ratio analysis as a component of benchmarking is that many financial ratios are well-established calculations derived from verified data. Benchmarking using ratio analysis can be useful to various audiences. For example, investors and managers interested in incorporate quantitative comparisons of a company to peers. Key terms: benchmark, a standard by which something is evaluated or measured. Ratio, a number representing a comparison between two things. Benchmarking financial ratios allow for comparisons and therefore are intertwined with the process of benchmarking, which refers to the process of comparing one's business to that of others or of the same company at a different point in time. In many cases, benchmarking involves comparisons of one company to the best companies in a comparable peer group or the average in that peer group or industry. In the process of benchmarking, an analyst or manager identifies the best firms in their industry or in another industry where similar processes exist and compares the results and processes of those studied to one's own results and processes on a specific indicator or series of indicators. Benchmarking can be done in many ways, and ratio analysis is only one of these. One benefit of ratio analysis as a component of benchmarking is that many financial ratios are well-established calculations derived from verified data. In benchmarking as a whole, benchmarking can be done on a variety of processes, meaning that definitions may change over time within the same organization due to changes in leadership and priorities. The most useful comparisons can be made when metrics definitions are common and consistent between compared units and over time. Benchmarking using ratio analysis can be useful to various audiences. From an investor perspective, benchmarking can involve comparing a company to peer companies that can be considered alternative investment opportunities from the perspective of an investor. In this process, the investor may compare the focus company to others in the peer group, leaders, averages, on certain financial ratios relevant to those companies and the investor's investment style. From a management perspective, benchmarking using ratio analysis may be a way for a manager to compare their company to peers using externally recognizable quantitative data. Defining trend analysis. Trend analysis consists of using ratios to compare company performance on an indicator over time, often to forecast or inform future events. Key points: trend analysis is the practice of collecting information and attempting to spot a pattern or trend in the same metric historically by examining it in tables or charts. Often this trend analysis is used to predict or inform decisions around future events. Trend analysis can be performed in different ways in finance. Fundamental analysis relies on historical financial statement analysis, often in the form of ratio analysis. Trend analysis using financial ratios can be complicated by changes to companies and accounting over time. For example, a company may change its business model and begin to operate in a new industry, or it may change the end of its financial year or the way it accounts for inventories. Key terms: sentiment, a general thought, feeling, or sense. Forecast, an estimation of a future condition. In addition to using financial ratio analysis to compare one company with others in its peer group, ratio analysis is often used to compare the company's performance on certain measures over time. Trend analysis is the practice of collecting information and attempting to spot a pattern or trend in the information. This often involves comparing the same metric historically, either by examining it in tables or charts. Often this trend analysis is used to forecast or inform decisions around future events, but it can be used to estimate uncertain events in the past. Trend analysis can be performed in different ways in finance. For example, in technical analysis, the direction of prices of a particular company's public stock is calculated through the study of past market data, primarily price and volume. Fundamental analysis, on the other hand, relies not on sentiment measures like technical analysis, but on financial statement analysis, often in the form of ratio analysis. Creditors and company managers also use ratio analysis as a form of trend analysis. For example, they may examine trends in liquidity or profitability over time. Trend analysis using financial ratios can be complicated by the fact that companies and accounting can change over time. For example, a company may change its business model so that it begins to operate in a new industry, or it may change the end of its financial year or the way it accounts for inventories. When examining historical trends in ratios, analysts will often make adjustments to the ratios for these reasons, perhaps performing some ratio analysis in which they segment out business segments that are not consistent over time, or they separate recurring from non-recurring items. Video. Profitability ratio 147. Watch the linked video opens a new window and read the enclosed article for an introduction to profitability ratios. Defining operating margin. The operating margin is a ratio that determines how much money a company is actually making in profit and equals operating income divided by revenue. Key points: the operating margin equals operating income divided by revenue. The operating margin shows how much profit a company makes for each dollar in revenue. Since revenues and expenses are considered operating in most companies, this is a good way to measure a company's profitability. Although it is a good starting point for analyzing many companies, there are items like interest and taxes that are not included in operating income. Therefore, the operating margin is an imperfect measurement of a company's profitability. Key terms: operating income, revenue, operating expenses. Does not include other expenses such as taxes and depreciation. Operating margins. The financial job of a company is to earn a profit, which is different than earning revenue. If a company doesn't earn a profit, their revenues aren't helping the company grow. It is not only important to see how much a company has sold, it is important to see how much a company is making. The operating margin, also called the operating profit margin or return on sales, is a ratio that shines a light on how much money a company is actually making in profit. It is found by dividing operating income by revenue, where operating income is revenue minus operating expenses. Operating margin formula. The operating margin is found by dividing net operating income by total revenue. The higher the ratio is, the more profitable the company is from its operations. For example, an operating margin of 0.5 means that for every dollar the company takes in revenue, it earns $0.50 in profit. A company that is not making any money will have an operating margin of 0. It is selling its products or services, but isn't earning any profit from those sales. However, the operating margin is not a perfect measurement. It does not include things like capital investment, which is necessary for the future profitability of the company. Furthermore, the operating margin is simply revenue. That means that it does not include things like interest and income tax expenses. Since non-operating incomes and expenses can significantly affect the financial well-being of a company, the operating margin is not the only measurement that investors scrutinize. The operating margin is a useful tool for determining how profitable the operations of a company are, but not necessarily how profitable the company is as a whole. Defining profit margin. Profit margin measures the amount of profit a company earns from its sales and is calculated by dividing profit, gross or net, by sales. Key points: profit margin is the profit divided by revenue. There are two types of profit margin: gross profit margin and net profit margin. A higher profit margin is better for the company, but there may be strategic decisions made to lower the profit margin or to even have it be negative. Key terms: net profit, the gross revenue minus all expenses. Gross profit, the difference between net sales and the cost of goods sold. Profit margin. Profit margin is one of the most used profitability ratios. Profit margin refers to the amount of profit that a company earns through sales. The profit margin ratio is broadly the ratio of profit to total sales times 100%. The higher the profit margin, the more profit a company earns on each sale. Since there are two types of profit, gross and net, there are two types of profit margin calculations. Recall that gross profit is simply the revenue minus the cost of goods sold, COGS. Net profit is the gross profit minus all other expenses. The gross profit margin calculation uses gross profit and the net profit margin calculation uses net profit. The difference between the two is that the gross profit margin shows the relationship between revenue and COGS, while the net profit margin shows the percentage of the money spent by customers that is turned into profit. Companies need to have a positive profit margin in order to earn income, although having a negative profit margin may be advantageous in some instances. Intentionally selling a new product below cost in order to gain market share. The profit margin is mostly used for internal comparison. It is difficult to accurately compare the net profit ratio for different entities. Individual businesses' operating and financing arrangements vary so much that different entities are bound to have different levels of expenditure. Comparing one business's arrangements with another has little meaning. A low profit margin indicates a low margin of safety. There is a higher risk that a decline in sales will erase profits and result in a net loss or a negative margin. Defining return on total assets, ROA. The return on assets ratio, ROA, measures how effectively assets are being used for generating profit. Key points: ROA is net income divided by total assets. The ROA is the product of two common ratios, profit margin and asset turnover. A higher ROA is better, but there is no metric for a good or bad ROA. And ROA depends on the company, the industry, and the economic environment. ROA is based on the book value of assets, which can be starkly different from the market value of assets. Key terms: asset, something or someone of any value, any portion of one's property or effects so considered. Net income, gross profit minus operating expenses and taxes. Return on assets. The return on assets ratio, ROA, is found by dividing net income by total assets. The higher the ratio, the better the company is at using their assets to generate income. ROA was developed by DuPont to show how effectively assets are being used. It is also a measure of how much the company relies on assets to generate profit. ROA can be broken down into multiple parts. The ROA is the product of two other common ratios, profit margin and asset turnover. When profit margin and asset turnover are multiplied together, the denominator of profit margin and the numerator of asset turnover cancel each other out, returning us to the original ratio of net income to total assets. Profit margin is net income divided by sales, measuring the percent of each dollar in sales that is profit for the company. Asset turnover is sales divided by total assets. This ratio measures how much each dollar in asset generates in sales. A higher ratio means that each dollar in assets produces more for the company. Limits of ROA. ROA does have some drawbacks. First, it gives no indication of how the assets were financed. A company could have a high ROA but still be in financial straits because all the assets were paid for through leveraging. Second, the total assets are based on the carrying value of the assets, not the market value. If there is a large discrepancy between the carrying and market value of the assets, the ratio could provide misleading numbers. Finally, there is no metric to find a good or bad ROA. Companies that operate in capital-intensive industries will tend to have lower ROAs than those who do not. The ROA is entirely contextual to the company, the industry, and the economic environment. Defining return on equity, ROE. Return on equity, ROE, measures how effective a company is at using its equity to generate income and is calculated by dividing net profit by total equity. Key points: ROE is net income divided by total shareholders' equity. ROE is also the product of return on assets, ROA, and financial leverage. ROE shows how well a company uses investment funds to generate earnings growth. There is no standard for a good or bad ROE, but a higher ROE is better. Key terms: equity, ownership, especially in terms of net monetary value of a business. Return on equity. Return on equity, ROE, is a financial ratio that measures how good a company is at generating profit. ROE is the ratio of net income to equity. From the fundamental equation of accounting, we know that equity equals net assets minus net liabilities. Equity is the amount of ownership interest in the company and is commonly referred to as shareholders' equity, shareholders' funds, or shareholders' capital. In essence, ROE measures how efficient the company is at generating profits from the funds invested in it. A company with a high ROE does a good job of turning the capital invested in it into profit, and a company with a low ROE does a bad job. However, like many of the other ratios, there is no standard way to define a good ROE or a bad ROE. Higher ratios are better, but what counts as good varies by company, industry, and economic environment. ROE can also be broken down into other components for easier use. ROE is the product of the net margin, profit margin, asset turnover, and financial leverage. Also note that the product of net margin and asset turnover is return on assets, so ROE is ROA times financial leverage. Breaking ROE into parts allows us to understand how and why it changes over time. For example, if the net margin increases, every sale brings in more money, resulting in a higher overall ROE. Similarly, if the asset turnover increases, the firm generates more sales for every unit of assets owned, again resulting in a higher overall ROE. Finally, increasing financial leverage means that the firm uses more debt financing relative to equity financing. Interest payments to creditors are tax-deductible, but dividend payments to shareholders are not. Thus, a higher proportion of debt in the firm's capital structure leads to higher ROE. Financial leverage benefits diminish as the risk of defaulting on interest payments increases. So if the firm takes on too much debt, the cost of debt rises as creditors demand a higher risk premium and ROE decreases. Increased debt will make a positive contribution to a firm's ROE only if the matching return on assets, ROA, of that debt exceeds the interest rate on the debt. Video, Liquidity Ratios, 3.6. View the following video for an introduction to liquidity ratios. Liquidity ratios defining current ratio is a financial ratio that measures whether or not a firm has enough resources to pay its debts over the next 12 months. Key points: the liquidity ratio expresses a company's ability to repay short-term creditors out of its total cash. The liquidity ratio is the result of dividing the total cash by short-term borrowings. The current ratio is a financial ratio that measures whether or not a firm has enough resources to pay its debts over the next 12 months. Current ratio equals current assets/current liabilities. Acceptable current ratios vary from industry to industry and are generally between 1.5 and 3 for healthy businesses. Key terms: working capital management. Decisions related to working capital and short-term financing are referred to as working capital management. These involve managing the relationship between a firm's short-term assets and its short-term liabilities. Current ratio: current assets divided by current liabilities. Video. The current ratio and liquidity, 4.4. Watch the linked video. Opens a new window on lynda.com for definitions on current and liquidity ratios. Liquidity ratio expresses a company's ability to repay short-term creditors out of its total cash. The liquidity ratio is the result of dividing the total cash by short-term borrowings. It shows the number of times short-term liabilities are covered by cash. If the value is greater than 1.00, it means it is fully covered. Liquidity ratio may refer to reserve requirement, a bank regulation that sets the minimum reserves each bank must hold. Acid test, a ratio used to determine the liquidity of a business entity. Current ratio. The current ratio is a financial ratio that measures whether or not a firm has enough resources to pay its debts over the next 12 months. It compares a firm's current assets to its current liabilities. It is expressed as follows. Current asset is an asset on the balance sheet that can either be converted to cash or used to pay current liabilities within 12 months. Typical current assets include cash, cash equivalents, short-term investments, accounts receivable, inventory, and the portion of prepaid expenses that will be paid within a year. Current liabilities are often understood as all liabilities of the business that are to be settled in cash within the fiscal year or the operating cycle of a given firm, whichever period is longer. The current ratio is an indication of a firm's market liquidity and ability to meet creditors' demands. Acceptable current ratios vary from industry to industry and are generally between 1.5 and 3 for healthy businesses. If a company's current ratio is in this range, then it generally indicates good short-term financial strength. If current liabilities exceed current assets, the current ratio is below 1, then the company may have problems meeting its short-term obligations. If the current ratio is too high, then the company may not be efficiently using its current assets or its short-term financing facilities. This may also indicate problems in working capital management. In such a situation, firms should consider investing excess capital into middle and long-term objectives. Low values for the current or quick ratios, values less than 1, indicate that a firm may have difficulty meeting current obligations. However, low values do not indicate a critical problem. If an organization has good long-term prospects, it may be able to borrow against those prospects to meet current obligations. Some types of businesses usually operate with a current ratio less than 1. For example, if inventory turns over much more rapidly than the accounts payable do, then the current ratio will be less than 1. This can allow a firm to operate with a low current ratio. If all other things were equal, a creditor who is expecting to be paid in the next 12 months would consider a high current ratio to be better than a low current ratio. A high current ratio means that the company is more likely to meet its liabilities which fall due in the next 12 months. Defining the acid test, quick ratio. The acid test or quick ratio measures the ability of a company to use its assets to retire its current liabilities immediately. Key points: quick ratio equals cash and cash equivalent plus marketable securities plus accounts receivable / current liabilities. Acid test ratio equals current assets, inventory / current liabilities. Ideally, the acid test ratio should be 1:1 or higher. However, this varies widely by industry. In general, the higher the ratio, the greater the company's liquidity. Key terms: treasury bills or T-bills mature in 1 year or less. Like zero-coupon bonds, they do not pay interest prior to maturity. Instead, they are sold at a discount of the par value to create a positive yield to maturity. Quick ratio in finance. The acid test, also known as quick ratio or liquid ratio, measures the ability of a company to use its near cash or quick assets to extinguish or retire its current liabilities immediately. Quick assets include those current assets that presumably can be quickly converted to cash at close to their book values. A company with a quick ratio of less than 1 cannot pay back its current liabilities. Cash and cash equivalents are the most liquid assets found within the asset portion of a company's balance sheet. Cash equivalents are assets that are readily convertible into cash, such as money market holdings, short-term government bonds or treasury bills, marketable securities, and commercial paper. Cash equivalents are distinguished from other investments through their short-term existence. They mature within 3 months, whereas short-term investments are 12 months or less, and long-term investments are any investments that mature in excess of 12 months. Another important condition that must be satisfied by cash equivalents is that the investment should have insignificant risk of change in value. Thus, common stock cannot be considered a cash equivalent, but preferred stock acquired shortly before its redemption date can be. Acid test ratio. Acid test often refers to cash ratio instead of quick ratio. Note that inventory is excluded from the sum of assets in the quick ratio, but included in the current ratio. Ratios are tests of viability for business entities, but do not give a complete picture of the business's health. A business with large accounts receivable that won't be paid for a long period, say 120 days, essential business expenses, and accounts payable that are due immediately may appear to have a healthy quick ratio when in actuality, the business could run out of cash. In contrast, if the business has negotiated fast payment or cash from customers and long terms from suppliers, it may have a very low quick ratio and yet be very healthy. The acid test ratio should be 1:1 or higher. However, this varies widely by industry. The higher the ratio, the greater the company's liquidity will be, better able to meet current obligations using liquid assets. Video: debt management ratios. Watch the following video to learn about debt management ratios. Financial ratios. Debt management. Defining total debt to total assets. The debt ratio is expressed as total debt total assets, total debt total assets. Key points: the debt ratio measures the firm's ability to repay long-term debt by indicating the percentage of a company's assets that are provided via debt. Total debt total assets, total debt total assets. The higher the ratio, the greater risk will be associated with the firm's operation. Key terms: goodwill. Goodwill is an accounting concept meaning the value of an asset owned that is intangible but has a quantifiable, prudent value in a business, for example, a reputation the firm enjoyed with its clients. Debt to total assets ratio, after-tax income divided by liabilities. Financial ratios quantify many aspects of a business and are an integral part of the financial statement analysis. Financial ratios are categorized according to the financial aspect of the business which the ratio measures. Financial ratios allow for comparisons between companies, between industries, between different time periods for one company, between a single company and its industry. Average ratios generally are not useful unless they are benchmarked against something else, like past performance or another company. Thus, the ratios of firms in different industries are usually difficult to compare because they face different risks, capital requirements, and competition. Debt ratios measure the firm's ability to repay long-term debt. It is a financial ratio that indicates the percentage of a company's assets that are provided via debt. It is the ratio of total debt, the sum of current liabilities and long-term liabilities, and total assets, the sum of current assets, fixed assets, and other assets such as goodwill. Debt ratio equals total debt total assets. Debt ratio equals total debt total assets, or alternatively, debt ratio equals total liability total assets. Debt ratio equals total liability total assets. The higher the ratio, the greater risk will be associated with the firm's operation. In addition, high debt-to-assets ratio may indicate low borrowing capacity of a firm, which in turn will lower the firm's financial flexibility. Like all financial ratios, a company's debt ratio should be compared with their industry average or other competing firms. Total liabilities divided by total assets. The debt/asset ratio shows the proportion of a company's assets which are financed through debt. If the ratio is less than 0.5, most of the company's assets are financed through equity. If the ratio is greater than 0.5, most of the company's assets are financed through debt. Companies with high debt/asset ratios are said to be highly leveraged, not highly liquid as stated above. A company with a high debt ratio, highly leveraged, could be in danger if creditors start to demand repayment of debt. Defining price/earnings ratio. Price to earnings ratio, market price per share/annual earnings per share, is used as a guide to the relative values of companies. Key points: P/E/ratio equals market price per share annual earnings per share. P ratio equals market price per share annual earnings per share. The P/E/PE ratio is a widely used valuation multiple used as a guide to the relative values of companies. For example, a higher P/E/PE ratio means that investors are paying more for each unit of current net income, so the stock is more expensive than one with a lower P/E/PE ratio. Different types of P/E/PE include trailing P/E/PE or PE/TUM, trailing P/E/PE from continued operations, and forward P/E/PE or PEV/PF. Key terms: time value of money, the value of money, figuring in a given amount of interest and over a given amount of time. Inflation, an increase in the general level of prices or in the cost of living. Price/earnings ratio in stock trading, the price to earnings ratio of a share, also called its P/E/PE or simply multiple, is the market price of that share divided by the annual earnings per share, EPS. The P/E/PE ratio is a widely used valuation multiple used as a guide to the relative values of companies. A higher P/E/PE ratio means that investors are paying more for each unit of current net income, so the stock is more expensive than one with a lower P/E/PE ratio. The P/E/PE ratio can be regarded as being expressed in years. The price is in currency per share, while earnings are in currency per share per year, so the P/E/PE ratio shows the number of years of earnings that would be required to pay back the purchase price, ignoring inflation, earnings growth, and the time value of money. Price-earnings ratios as a predictor of 20-year returns. The horizontal axis shows the real price-earnings ratio of the S&P Composite Stock Price Index as computed in irrational exuberance, inflation-adjusted price, divided by the prior 10-year mean of inflation-adjusted earnings. The vertical axis shows the geometric average real annual return on investing in the S&P Composite Stock Price Index, reinvesting dividends, and selling 20 years later. Note that over the last century, as the PE/PE ratio has decreased, annualized returns have increased. PE/ratio equals market price per share annual earnings per share. P ratio equals market price per share annual earnings per share. The price per share in the numerator is the market price of a single share of the stock. The earnings per share in the denominator may vary depending on the type of PE/PE. The types of PE/PE include the following: trailing P/E or P/E-term. Here, earning per share is the net income of the company for the most recent 12-month period, divided by the weighted average number of common shares in issue during the period. This is the most common meaning of PE/PE if no other qualifier is specified. Monthly earnings data for individual companies are not available and usually fluctuate seasonally, so the previous 4 quarterly earnings reports are used, and earnings per share are updated quarterly. Note, each company chooses its own financial year, so the timing of updates will vary from one to another. Trailing P/E from continued operations. Instead of net income, this uses operating earnings, which exclude earnings from discontinued operations, extraordinary items, one-off windfalls and write-downs, and accounting changes. Longer-term PE/PE data, such as Shiller's, use net earnings. Forward P/E, P/EF, or estimated P/E. Instead of net income, this uses estimated net earnings over the next 12 months. Estimates are typically derived as the mean of those published by a select group of analysts. Selection criteria are rarely cited. In times of rapid economic dislocation, such estimates become less relevant as the situation changes. New economic data is published, and or the basis of forecasts becomes obsolete more quickly than analysts adjust their forecasts. By comparing price and earnings per share for a company, one can analyze the market's stock valuation of a company and its shares relative to the income the company is actually generating. Stocks with higher or more certain forecast earnings growth will usually have a higher PE/PE, and those expected to have lower or riskier earnings growth will usually have a lower PE/PE. Investors can use the PE/PE ratio to compare the value of stocks. For example, if one stock has a PE/PE twice that of another stock, all things being equal, especially the earnings growth rate, it is a less attractive investment. Companies are rarely equal, however, and comparisons between industries, companies, and time periods may be misleading. The PE/PE ratio in general is useful for comparing valuation of peer companies in a similar sector or group. The PE/PE ratio of a company is a significant focus for management in many companies and industries. Managers have strong incentives to increase stock prices, firstly as part of their fiduciary responsibilities to their companies and shareholders, but also because their performance-based remuneration is usually paid in the form of company stock or options on their company's stock, a form of payment that is supposed to align the interests of management with the interests of other stockholders. The stock price can increase in one of two ways, either through improved earnings or through an improved multiple that the market assigns to those earnings. In turn, the primary driver for multiples, such as the PE/PE ratio, is through higher and more sustained earnings growth rates. Companies with high PE/PE ratios but volatile earnings may be tempted to find ways to smooth earnings and diversify risk. This is the theory behind building conglomerates. Conversely, companies with low PE/PE ratios may be tempted to acquire small high-growth businesses in an effort to rebrand their portfolio of activities and burnish their image as growth stocks and thus obtain a higher PE/PE rating. Defining book ratio: the price-to-book ratio is a financial ratio used to compare a company's current market price to its book value. Key points: the calculation can be performed in two ways. 1. The company's market capitalization can be divided by the company's total book value from its balance sheet. 2. Using per share values, which is to divide the company's current share price by the book value per share. A higher PB/ratio implies that investors expect management to create more value from a given set of assets, all else equal. Technically, P/B can be calculated either including or excluding intangible assets and goodwill. Key terms: outstanding shares. Shares outstanding are all the shares of a corporation that have been authorized, issued, and purchased by investors and are held by them. Price/book ratio. The price-to-book ratio, or PB/PP ratio, is a financial ratio used to compare a company's current market price to its book value. The calculation can be performed in two ways, but the result should be the same either way. In the first way, the company's market capitalization can be divided by the company's total book value from its balance sheet. Market capitalization/total book value. The second way, using per share values, is to divide the company's current share price by the book value per share, i.e., its book value divided by the number of outstanding shares. Share price/book value per share. As with most ratios, this one varies a fair amount by industry. Industries that require more infrastructure capital for each dollar of profit will usually trade at PB/PP ratios much lower than, for example, consulting firms. PB/PP ratios are commonly used to compare banks because most assets and liabilities of banks are constantly valued at market values. A higher PB/PP ratio implies that investors expect management to create more value from a given set of assets, all else equal, and or that the market value of the firm's assets is significantly higher than their accounting value. PB/PP ratios do not, however, directly provide any information on the ability of the firm to generate profits or cash for shareholders. This ratio also gives some idea of whether an investor is paying too much for what would be left if the company went bankrupt immediately. For companies in distress, the book value is usually calculated without the intangible assets that would have no resale value. In such cases, PB/PB should also be calculated on a diluted basis because stock options may well vest on the sale of the company, change of control, or firing of management. It is also known as the market-to-book ratio and the price-to-equity ratio, which should not be confused with the price-to-earnings ratio, and its inverse is called the book-to-market ratio. Total book value versus tangible book value. Technically, PB/PB can be calculated either including or excluding intangible assets and goodwill. When intangible assets and goodwill are excluded, the ratio is often specified to be price to tangible book value or price to tangible book. Financial ratio analysis. Definition, types, examples, and how to use. What is ratio analysis? Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and income statement. Ratio analysis is a cornerstone of fundamental equity analysis. Ratio analysis compares line item data from a company's financial statements to reveal insights regarding profitability, liquidity, operational efficiency, and solvency. Ratio analysis can mark how a company is performing over time while comparing a company to another within the same industry or sector. Ratio analysis may also be required by external parties that set benchmarks often tied to risk. While ratios offer useful insight into a company, they should be paired with other metrics to obtain a broader picture of a company's financial health. Examples of ratio analysis include current ratio, gross profit margin ratio, inventory turnover ratio. What does ratio analysis tell you? Investors and analysts employ ratio analysis to evaluate the financial health of companies by scrutinizing past and current financial statements. Comparative data can demonstrate how a company is performing over time and can be used to estimate likely future performance. This data can also compare a company's financial standing with industry averages while measuring how a company stacks up against others within the same sector. Investors can use ratio analysis easily, and every figure needed to calculate the ratios is found on a company's financial statements. Ratios are comparison points for companies. They evaluate stocks within an industry. Likewise, they measure a company today against its historical numbers. In most cases, it is also important to understand the variables driving ratios, as management has the flexibility to, at times, alter its strategy to make its stock and company ratios more attractive. Generally, ratios are typically not used in isolation, but rather in combination with other ratios. Having a good idea of the ratios in each of the 4 previously mentioned categories will give you a comprehensive view of the company from different angles and help you spot potential red flags. 6 basic financial ratios and what they reveal. Ratios track company performance. They can rate and compare one company against another that you might be considering investing in. The term ratio conjures up complex and frustrating high school math problems, but that need not be the case. Ratios can help make you a more informed investor when they're properly understood and applied. KEYTA's fundamental analysis relies on data from corporate financial statements to compute various ratios. Fundamental analysis is used to determine a security's intrinsic or true value so it can be compared with the security's market value. There are 6 basic ratios that are often used to pick stocks for investment portfolios. Ratios include the working capital ratio, the quick ratio, earnings per share, EPS, price earnings, P/E, debt to equity, and return on equity, ROE. Most ratios are best used in combination with others rather than singly to accomplish a comprehensive picture of a company's financial health. 1. Working capital ratio. Assessing the health of a company in which you want to invest involves measuring its liquidity. The term liquidity refers to how easily a company can turn assets into cash to pay short-term obligations. The working capital ratio can be useful in helping you measure liquidity. It represents a company's ability to pay its current liabilities with its current assets. Working capital is the difference between a firm's current assets and current liabilities. Current assets. Current liabilities equals working capital. The working capital ratio, like working capital, compares current assets to current liabilities and is a metric used to measure liquidity. The working capital ratio is calculated by dividing current assets by current liabilities. Current assets/current liabilities equals working capital ratio. Let's say that XYZ company has current assets of $8 million and current liabilities of $4 million. The working capital ratio is $8 million/$4 million. That's an indication of healthy short-term liquidity. But what if 2 similar companies each had ratios of 2? The firm with more cash among its current assets would be able to pay off its debts more quickly than the other. A working capital ratio of 1 can imply that a company may have liquidity troubles and not be able to pay its short-term liabilities. But the trouble could be temporary and later improve. A working capital ratio of 2 or higher can indicate healthy liquidity and the ability to pay short-term liabilities, but it could also point to a company that has too much in short-term assets, such as cash. Some of these assets might be better used to invest in the company or to pay shareholder dividends. It can be a challenge to determine the proper category for the vast array of assets and liabilities on a corporate balance sheet to decipher the overall ability of a firm to meet its short-term commitments. 2. Quick ratio. The quick ratio is also called the acid test. It's another measure of liquidity. It represents a company's ability to pay current liabilities with assets that can be converted to cash quickly. The calculation for the quick ratio is current assets, inventoried prepaid expenses/current liabilities, current assets minus inventory minus prepaid expenses divided by current liabilities. The formula removes inventory because it can take time to sell and convert inventory into liquid assets. 2XYZ company has $8 million in current assets, $2 million in inventory and prepaid expenses, and $4 million in current liabilities. That means the quick ratio is 1.5, $8 million, $2 million/$4 million. It indicates that the company has enough money to pay its bills and continue operating. A quick ratio of less than 1 can indicate that there aren't enough liquid assets to pay short-term liabilities. The company may have to raise capital or take other actions. On the other hand, it may be a temporary situation. 3. Earnings per share, EPS. When buying a stock, you participate in the future earnings or the risk of loss of the company. Earnings per share, EPS, is a measure of the profitability of a company. Investors use it to gain an understanding of company value. The company's analysts calculate EPS by dividing net income by the weighted average number of common shares outstanding during the year, net income/weighted average equals earnings per share. Earnings per share will also be zero or negative if a company has zero earnings or negative earnings representing a loss. A higher EPS indicates greater value. 3-4. Price-earnings ratio, P/E, called P/E for short. This ratio is used by investors to determine a stock's potential for growth. It reflects how much they would pay to receive $1 of earnings. It's often used to compare the potential value of a selection of stocks. To calculate the P/E ratio, divide a company's current stock price by its earnings per share. To calculate the P/E ratio, current stock price/earning per share equals price-earnings ratio. For a company's P/E ratio would be 9.49, $46.51/$4.90 if it closed trading at $46.51 a share and the EPS for the past 12 months averaged $4.90. Investors would spend $9.49 for every generated dollar of annual earnings. Investors have been willing to pay more than 20 times the EPS for certain stocks when they felt that a future growth in earnings would give them adequate returns on their investments. The P/E ratio will no longer make sense if a company has zero or negative earnings. It will appear as in /A for not applicable. Ratios can help improve your investing results when they're properly understood and applied. 5. Debt-to-equity ratio. What if your prospective investment target is borrowing too much? This can increase fixed charges, reduce earnings available for dividends, and pose a risk to shareholders. The debt-to-equity D/E ratio measures how much a company is funding its operations using borrowed money. It can indicate whether shareholder equity can cover all debts if necessary. Investors often use it to compare the leverage used by different companies in the same industry. This can help them to determine which might be a lower risk investment. Divide total liabilities by total shareholders' equity to calculate the debt-to-equity ratio. Total liabilities/total shareholders' equity equals debt-to-equity ratio. Let's say that company XYZ has $3.1 million worth of loans and shareholders' equity of $13.3 million. That works out to a modest ratio of 0.23, which is acceptable under most circumstances. But like all other ratios, the metric must be analyzed in terms of industry norms and company-specific requirements. 5-6. Return on equity, ROE. Return on equity, ROE, measures profitability and how effectively a company uses shareholder money to make a profit. ROE is expressed as a percentage of common stock shareholders. It's calculated by taking net income, income less expenses and taxes, figured before paying common share dividends and after paying preferred share dividends. Divide the result by total shareholders' equity, net income, expenses and taxes before paying common share dividends and after paying preferred share dividends, / total shareholders' equity equals return on equity. 6. Let's say XYZ company's net income is $1.3 million. Its shareholder equity is $8 million. ROE is therefore 16.25%. The higher the ROE, the better the company is at generating profits using shareholder equity. What's a good ROE? Return on equity, or ROE, is a metric used to analyze investment returns. It's a measure of how effectively a company uses shareholder equity to generate income. You might consider a good ROE to be one that increases steadily over time. This could indicate that a company does a good job using shareholder funds to increase profits. That can in turn increase shareholder value. What is fundamental analysis? Fundamental analysis is the analysis of an investment or security to discover its true or intrinsic value. It involves the study of economic, industry, and company information. Fundamental analysis can be useful because an investor can determine if the security is fairly priced, overvalued, or undervalued by comparing its true value to its market value. Fundamental analysis contrasts with technical analysis, which focuses on determining price action and uses different tools to do so, such as chart patterns and price trends. Is a higher or lower P/E ratio better? It depends on what you're looking for in an investment. A P/E ratio measures the relationship of a stock's price to earnings per share. A lower P/E ratio can indicate that a stock is undervalued and perhaps worth buying, but it could be low because the company isn't financially healthy. A higher P/E can indicate that a stock is expensive, but that could be because the company is doing well and could continue to do so. The best way to use P/E is often as a relative value comparison tool for stocks you're interested in, or you might want to compare the P/E of one or more stocks to an industry average. The bottom line financial ratios can help you pick the best stocks for your portfolio and build your wealth. Dozens of financial ratios are used in fundamental analysis. We've briefly highlighted 6 of the most common and the easiest to calculate. Remember that a company cannot be properly evaluated using just one ratio in isolation. Be sure to put a variety of ratios to use for more confident investment decision-making.